Warning, this video and all other videos on this channel are for entertainment purposes only. The content of this video and all other videos on this channel are the opinions of the creator only and do not constitute legal, trading, investment, or financial advice of any kind. Investing carries a high level of risk and the majority of retail clients lose money. Do not invest any capital unless you understand the risks and you are prepared to lose it all. Right, hello and welcome to Camel Finance. I'm your boy Camel, and I don't really have time to make a video today because I am playing Uncle Camel today. For anyone that doesn't know, I am the uncle of last resort in my family. So I've got a 4-year-old niece and a 2-year-old nephew, and if they ask Uncle Camel to babysit, it means they really have run out of other options. So those kids are coming over for a bit, which should be fun as always. I just wanted to address one thing and then put you onto a podcast I did over the weekend. There's an outside chance I'm going to do a live stream this afternoon as well, so look out for that. The main thing I wanted to cover today is this whole thing with the bond yields, okay? So if we take a look at this, the 10-year note yield is now up over 20 basis points since Friday's intraday low, 20 basis points in a matter of hours without any material news. For the first time in almost 5 weeks, the 10-year note yield is set to break above 4.5%, and the bond markets are trading like rate cuts got cancelled and inflation is on the rise. So are the bond markets telling us something, or is this all doom and gloom? Right? Is this all just doom and gloom? Now, admittedly, when you put it on a 5-minute chart, this looks pretty insane, right? This looks like perhaps it's the end of the world. And by the end of the world, I simply mean that more hikes are coming or inflation is going to be super sticky. But I'm here to tell you that that's not really the case, okay? Inflation, by all accounts, is still coming off. And until proven otherwise, then it seems silly to just start assuming inflation is going to be sticky. Similarly with the rate cuts, okay, yeah, it's easy to doom post like this and say, oh, well, the end of the world is coming. And there was plenty of tweets like that circulating yesterday. I'm not going to show this account because I'm not trying to put anyone on blast here, but you know, this is the tweet. Worsening, this is not good, this is very bad. And it's a bunch of these yields moving up a bit. Okay, but this alone doesn't mean anything. We need the context of how this fits into the chart. This same account keeps posting shots just like this of banking stocks and tweeting things like it's the start of the banking crisis, but they've been down 0.2%. Okay, that's not what a banking crisis looks like. If it really was a banking crisis, they wouldn't all be down less than 0.5%. These bank stocks that it was showing in another tweet would be down 5, 6, 10% each. So doom posting is easy, okay, but context is key. And so when we move into the charts, okay, and approach this with objectivity, has anything changed here? And the simple answer is no, it has not, okay? So far, we are still contained below resistance. And the invalidation, as I've stated 100 times before, is if this thing breaks out, okay, then we've got invalidation. Then we've potentially got the bond market signaling that we're going to be maintaining a higher for longer stance. But if this thing turns out to just be another touch of resistance before a rollover, then again, I can stand here with full confidence and say, tell that to the bond market. If I pull up my classic chart right here, okay, the 2-year yield in green and the Fed funds rate in orange, I've been making the case that this is the signal, okay? If the 2-year yield starts to come off, then every other time in history this happened, it was because the central banks know rate cuts are coming and therefore they start to price the yields accordingly. So usually when the 2-year yield leads lower, we see the onset of a cutting cycle shortly thereafter, as you can see in every one of these cases, okay? Every one of these cases, we see the 2-year yield lower and the onset of a cutting cycle shortly thereafter. And this is where that whole phrase, tell that to the bond market comes. If you think rates are going to be hiked, if you think they're going to be maintained higher for longer, well, the bond market disagrees as soon as it starts to move lower. So when we now pull up a 2-year bond yield chart, what can you see? Does this speak to any kind of invalidation occurring? Like, it just simply doesn't, okay? For invalidation to occur, we'd have to see this break out and off we go. And then we can say, okay, Camel, well, the bond market has now spoken. But all the while, we continue to look weak. All the while, we continue to make lower lows and lower highs. Then it only seems reasonable to me to assume that something like this is not too far away. And if, of course, it does, then it means this will morph into a look where the 2-year yield is leading lower, and every other time in history that occurs, the Fed begins cutting rates shortly thereafter. There are, of course, still other factors in play that suggests that Fed is probably closer to cutting than hiking or remaining paused. Because number one, unemployment keeps getting worse and worse. It's so bad that they keep having to lie about the data and revise it down quietly a couple of weeks later. Number two, inflation continues to come off. Like I said earlier, unless we start to see sticky prints, then what is the point in saying inflation is sticky, okay? By all other metrics, by the M2 rate of change, by the leading indicators I show every weekend at the deep dive, and by Trueflation, okay, inflation has been tamed. Not to mention PCE keeps coming in cold. The Fed has essentially done its job. We have essentially tamed inflation, and therefore it has some quote-unquote credibility in being able to start to cut rates in the not-too-distant future. Furthermore, we've already seen the ECB, the Czech Republic, the Bank of Canada, the Bank of Switzerland, the Swedish Central Bank, they've all cut rates already. So it's just the Bank of England and the Fed left to go. And as always, the Camel Crew stays objective, okay? The Camel Crew knows where invalidation occurs. Like I said a million times, break out, and then suddenly we can stop telling that to the bond market. But all the while, this continues to look weak. All the while, all we're seeing is a mere counter-trend bounce into resistance that is about to roll over again. Then it seems silly to start drawing conclusions and doom posting like this is the end of the world, right? Okay, especially when we're biased, because who trades the 5-minute chart for yields? Okay, do you? No, I don't either. So once again, I'm here to say, okay, nothing has really changed as of yet. Things can change and they can change quickly, but they haven't changed yet. All the while, this continues to morph into a downside move for the 2-year yield. It tells us that the central banks that always know something before the market, the central banks are therefore pricing in cuts that they know to be coming. And similarly, invalidation occurs if this thing continues to move higher and breaks out, which so far, it doesn't look anything like that to me. So once again, I say, tell that to the bond market. By popular request, we added some tell that to the bond market merch in the shop, and you can use a discount code here in the community tab if you're interested. Did I just shill merch? Make a note of that. Don't let me get away with that more than once. And the last thing I wanted to love you and leave you with for today is I did a fantastic podcast with a channel OG right here. So I'll link this video. I'll put it in the middle of the screen. I'll put it nice and big for you to just click on. Highly recommend you go and check that out. It was a great conversation. Like I said, I'll link that at the end. And other than that, I hope you have a fantastic day. I may or may not hop back on live later, depending on how worn out I am from the kids. Otherwise, I'll be back tomorrow as normal. And until next time, take care from me. All the best. Cheers. Bye.